Hello friends, welcome to Raj Solution. Today I will describe the investment management of security analysis. First of all, we have to know what is investment. Basically, investment is nothing. Investment is employing money in different assets in the present situation with expectation of positive return in the near future. Then, types of investors. Basically, the types of investors are of three types. According to the individual's objective, according to the investment time horizon, and according to the risk tolerance. So first is according to the individual's objective. Individual's objective, the first type of investors is safety dependent. Although no investment option is completely safe, but all the investors always want to keep their money or keep their assets in safe. Next is growth dependent investors. Majority of the investors, they invest to receive capital gains. They gains from the stocks, mutual funds, gold, real estate, etc. They always want to growth of their assets. Next is income. Objective of the generating a second source of income. Most of the investors invest money or assets to generate their passive income or second source of income. Example, bank fixed deposit, corporate and government bonds, etc. Next is tax exemption. Some people invest their money. Some people, that means most of the people who are businessmen and industrialists, they invest their money for reducing their tax liabilities. Next is liquidity dependent investors. Many investment options are not open-ended. Most of the investment options are mostly close-ended. That's why this means they cannot be sold and converted into cash instantly. That's why liquidity dependent investors invest their money or their assets. Next is investment horizon period. That means according to the investment horizon period, there are three types of investors. But at first we have to know what is investment horizon period. Basically, investment horizon period by year or investment time horizon, that is a period where one expects to hold an investment for a specific goal or to get expected return from it. So according to investment horizon period, investors are basically of three types. First of all, short-term dependent, second is mid-term dependent, and third is long-term dependent. Short-term dependents, they invest for mostly 1 to 5 years. Mid-term dependent, they are most of invest for 5 to 10 years, and for long-term, they invest for above 10 years. And this third is risk tolerance. According to risk tolerance, the investors are of three types. First is conservative, second is moderate, and third is aggressive. First is conservative. So we know that market is always volatile. These type of investors always try to keep their volatility factor of the market as low as possible. They always avoid the risk factor, although it's not possible, but it is minimizable. That's why they always invest in fixed deposit, debt funds, golds, real estate, etc. Most of cases, conservative factors are mostly old age people. Then next is moderate. Moderate, that means they are willing to take moderate risks that do not rock their boats. That means they want to get better return, but they don't want to take much risk. But in this case, they play always safe game. Then next is aggressive. These type of investors are very much calculative. They know just when to put their hands in the volatile investments, just to pull out at the right time with the supremely high returns. They are always ready to take calculative risk. They always invest according to the growth potential of the company. That's why they always invest in equity, stocks, bonds, etc. Next, that is the investment objectives. In the objective part, we have found the 9 objectives of investments. First is growth. According to the growth, every investor wants to growth of their asset in the form of liquidity or cash. That's why they invest in stocks, mutual funds, gold, real estate, etc. Then next is income. Most of the investors invest for generating passive income or generating the second source of income for better standard of living in the upcoming future. Then next is safety. Although investment consists of risk, but all the investors try to minimize their risks. They want safety of their assets. Then return. Then always return, that is expect better positive return. That means the investors always expect better positive return from their investments. That's why they invest. Then next objective is risk. Aggressive investors takes the high risks for getting high returns in future, but conservative investors try to minimize the risk and get the low return. The risk taking capability or risk taking ability depends on investors to investors or varies on investors to investors. And next is liquidity. Most of the investors invest in open-ended policy for the liquidity facility, which is helpful for the upcoming future. If there is any requirement in near future, then it will be able to convert the investment or the security or the funds into the cash easily. That's why liquidity is the most important objective. Then next is tax exemption. Several number of industrialists or businessmen invest their asset for getting the tax benefit or for getting the tax exemption facility. That's why they invest their money to the different bonds, different securities, different funds, etc. Then next objective is flexibility. Terms and conditions should be flexible for the investors. Always in a company, terms and conditions should be flexible for the investors, which will insist the investors to invest in particular organization. And last objective is convenience. It is simple that where the investor will get better convenience, there they will invest. That means convenience in terms of facility related support, flexibility, etc. Next is investment constraints. The first constraint is liquidity. Suppose within the next year, an investor needs 10 lakhs rupees for the higher education of his son. Then the 10 lakhs is liquidity constraint because it needs to be set aside in the form of cash. That's why liquidity is a constraint. Then next constraint is time horizon. Short and long time period affects on investors' ability to accept the risk. If an investor has a long time horizon, the investors may have great ability to take the risks because he would have longer time period to compensate any losses. But for the short time horizon, or for the customer or for the investor who has the short time horizon, for him it will be the opposite. That's why time horizon is a constraint. Then tax. According to the current tax liability, we have to justify the taxability. If an investor is currently in a high tax liability, it will be important to focus on investments that would make the investment situation, that would not investment situations worse. Then next is legal and regulatory constraints. Legal and regulatory constraints says, suppose it is mainly legal and regulatory constraints mainly applicable for the professional and institutional investors. Professional and institutional investors need to be aware of the rules and regulations of the company. Then next is unique circumstances. Unusual considerations that affect the investor's risk return profile. Suppose, for example, suppose an investor might place on investing in any company which is not socially responsible. Suppose he is investing on a alcohol company. So then that is the constraints. Next, then we will describe the investment process. The first process or the first step is understanding the clients. That means we have to understand the demand of the clients according to the risk taking capacity of the clients, according to the present tax liabilities of the clients, or according to the needs of the clients. Then next is asset allocation. Asset allocation, that means how to allocate the investment in different asset class, whether to invest in domestic assets or foreign assets. That is it. The next is portfolio strategy selection. According to the portfolio strategy selection, there are two types of strategy. First is active portfolio and second is passive portfolio. According to the active portfolio, its objective is investing is to outperform the market return by either buying securities which is undervalued or selling securities which is overvalued. And in the case of active portfolio, risk and return both are always high. Next strategy is passive portfolio. The strategy where the purpose is to generate returns equal to that of the market. Then next is asset selection decision. Because why asset selection decision is required? Within each asset class, there are different sub-asset class. Suppose, as for example, in equity, there are various types of stock, but we have to decide in which stock we will invest. That's why asset selection decision is required. Next is evaluating portfolio performance. Evaluating portfolio performance measures the performance of an investment with respect to a benchmark or with respect to a particular rate of return. Whether his objective or the customer's objective of the company or the company's objective are being achieved or not, or the investor's objective are being achieved or not. Then the most important two part. Basically, the investment process follows the two main important approach. First is top-down approach and second is bottom-up approach. First, we will describe the top-down approach. In top-down approach, or the basically top-down approach is described through the security analysis. It is done through the security analysis. During an investment, always an investor try to know about the highest security to the lowest. That's why its name is top-down approach. Then next is bottom-up approach. Bottom-up approach totally based on the attractive price. And successful investor always try to find out first the lowest price of the security or the lowest price of the fund, then go to the higher price of the fund. That's why its name is bottom-up approach. Then our next topic is hedging or safeguard. Hedging or safeguard is always important for our investors who want to save his or her investments. But at first we have to know what is hedging or what is safeguard. Hedging is an investment that protects your finances from a risky situation. It is done to minimize or offset the chance that your asset will lose value. It also limits your loss to a known amount if the asset does lose value. That means hedging provides you a safeguard. Next, what is the advantage of hedging? First advantage, short-term risk minimizing strategy for the long-term traders or investors. That means hedging provides the short-term risk minimizing strategy. The next advantage is it is used for locking the profit. That means it is used for getting the profit in a particular rate of a particular percentage of return. Then next is it allows traders to survive in hard market situations or hard market period. The next advantage is it gives the protection against commodity price changes, inflation, currency exchange rate changes, and interest rate changes, etc. The next advantage is it saves time for monitoring or adjusting portfolio with daily market volatility. Next, the disadvantage of hedging. That means what are the disadvantages of hedging? Basically, hedging involves the cost that can eat up your profit when the market condition is bad. It is the most disadvantage, and it is the most bad disadvantage. And next disadvantage is for most short-term traders. Suppose the traders who trade for per day. That means for a per day trader, hedging is a difficult strategy to follow. That means a per day trader can't follow the hedging strategy. Then next disadvantage is when a market is performing well, then hedging offer little benefits. Next is the difference between investment and speculation. On the basis of meaning, invest is the purchase of an asset with the hope of getting return is called investment. But according to the meaning, speculation is an act of conducting a risky financial transaction in the hope of substantial profit. Then on the basis of decision, investment depends on the fundamental factors, performance of the company, but speculation depends on the technical charts or market psychology. Then on the basis of time horizon, investment is long term, speculation is short term. Then on the basis of risk involved, investment involves moderate risk and speculation is high risk. That means where the risk is high, return always will be high, and where the risk is low, return always will be low. Then intent to profit. Profit in investment changes in value, and in speculation changes in price. Expected rate of return previously I have said. Then funds. In investment, an investor uses his own funds, but in speculation, and speculator use a borrowed funds. In investment, income is stable, but in speculation, income is uncertain or volatile because here risk is high. Then, on the basis of participants, investments in or investors are conservative mentality or cautious, but speculators are daring and careless. That's all for today. Keep growing, stay blessed. Thank you.